If you blinked, you might have missed it. That's because interest rates dropped nearly 0.25% in just a couple of days. And with that, we saw the 10-year fall from 4.8 to 4.28. And while that might sound like a small change, it could have a big impact on reshaping the housing market. So Josh, today's episode, we're going to talk about mortgage rates, what's recently happened, and whether or not our viewers, our listeners should expect that trend to continue.
It's been a big move, and really to answer that, I like to go back to kind of what our thoughts are, and we'll piggyback off the thoughts of Logan Mojashami, the lead analyst over at Housing Wire. He answers this question with a range. What do I see as the range of possibilities for 2025? And the answer was 7.25 to 5.75. It's a pretty big range, right, Jeb? 1.5% difference there. And we got in January very, very close to that 7.25, 7.125 probably per Mortgage News Daily, which is our preferred non-biased source for kind of the real level of rates. And we look at that today, we're down at least 0.5%, probably more than 0.5%. And the numbers that you hinted at tell us why. The 10-year Treasury, we were up at about 4.8 in early January, and now we're down under 4.3. And we are at a really critical spot right now. Without going nerdy and talking about technical analysis and whatnot, after making this nice move, we are at the 200-day moving average. A 200-day moving average, when you're above it, tells you that things are getting worse or yields are rising in the more intermediate term, in probably 3, 4, 5 month period. It's a longer term trend. But that's a pretty solid level of resistance. If we get below it, then it tells us that we should probably have more follow through. So we're roughly in the middle of that 5.75 to 7.25 range. At risk of sounding like a broken record, I mean, stop me if you've heard this one before. We've had several false starts multiple times since rates started increasing in 2022. They've gone up, come down, gone up, come down. Many times, especially last fall, they came down really fast, and then they spiked back up. I think it's going to be a little bit of work to break through that 200-day moving average. But if it does, we've got another, 0.5% of improvement potentially ahead of us. The question is, what happens in the market? What data comes out? How quickly and how quickly does the market react to that data, because they're gun shy? We've been burned 3 separate times on dips in rates since that 2022 spike. And I think we're going to see more of a slow grind this time, which is healthier for the overall market.
We often talk about real estate being local. Interest rates are kind of a personal thing. An interest rate, a interest rate in the market is different for every person, because maybe you have a lower rate for that than that, and that higher rate doesn't impact you. Maybe your rate's higher than that, and that lower rate, getting to that lower rate, changes the dynamic with affordability, with you maybe being able to qualify for more home or put more money in your pocket by refinancing. And so I think this episode's important in knowing that there's no clear direction at the moment in interest rates. We're going to talk about why we think interest rates have gone the direction that they've gone, why that could continue. But my advice to you as a listener, as a viewer, is to take advantage of the opportunity when they present themselves, right? Don't stand out there looking at, okay, interest rates dropped 0.25. I'm going to wait until they drop another 0.25 to do anything, when maybe that 0.25% saves you $300-400 a month in some cases, depending on your loan amount. So that's why we created something called the Rate Watch that allows Josh and the team here to monitor rates, to let you know when interest rates have reached a certain threshold, so that you can make the decision at that time whether or not it makes sense. But so you're not following it every single day. You can go there by going to theeducatedhomebuyer.com/rate watch. That'll get you on the list, a couple of questions for you, and then you're on it until you're not, until we're able to help you, at which case you stay on it, and then you'll continually be updated. But if you're in that process, we can help you. Make sure you go there and check that out. So with that, Josh, let's talk a little bit about things that we believe impacted that change in the 10-year, the spread. I mean, not the spread, the yield coming down, because it hasn't been clear. It's not, hey, the Fed came out and said this and this happened, or hey, interest rates were cut by this amount and we saw this. It's kind of, been, not as fancy or sexy as we would like to think.
Most of the data that we got in January, Jeb, was as expected. The December data that came out in January. So that run up, that spike in rates, was sort of a reaction to concerns about possible market reactions to Trump policy, generally the tariffs. So there was a lot of uncertainty and sort of just priced in an uncertainty premium. And that's why we ran all the way up to that high level of 4.8. That part was pretty clear. Then when we get in here to January, it's been a mixed message, or into February when that January data comes in. We got a really hot CPI report. And for one day, rates really spiked. And we're like, oh, this is not good. But several Fed speakers, several market analysts look at this and says, this is really a classic example of the January effect. Some of the things inside the CPI calculation get reset at the beginning of the year. And so there are reasons to believe that I think 5 of the last 6 January readings or in February of the following year have come out really hot for inflation. So the very next day, we had a tame PPI report, and some of the components inside the producer's price index translate over into the PCE index, which, as you guys well know, is the Fed's preferred measure of inflation. So that comes out tomorrow, but that was sort of a preview saying, hey, looks like it's not going to be hot like yesterday's CPI was. So we almost we did a round trip in 48 hours, a spike up one day, drop down the next day, followed the next day by a very tame retail sales figure for the month of January. And that is starting to show some weakness that we've been talking about. It's been sort of this anomaly for the last 2 years, this paradox that no one could explain. How are people still spending this money? Savings rate is low. Use of revolving credit is up, but the consumer is still spending money. So with that, we are finally starting to see cracks on that, especially with the high-end consumer. So if that were to happen, you're going to see the economy slow. And we see that in the quarterly reports and the conference calls that public companies are doing when they're holding their conference calls of saying, hey, what happened last quarter? And they have a Q&A. They're all saying there's definitely headwinds from restaurants saying people are preferring to eat at home because it's cheaper and more affordable. But even people eating at home, everyone wants to talk about eggs. They don't realize the volatility in eggs. I don't think it's a really good measure of inflation, but people are definitely feeling the hits and effects of inflation. And at a certain point, that decreases spending, and it is sort of a brake on the entire economy. So right now, the best explanation, Jeb, is there is a worry that if we don't get outright recession, we're at least going to have the economy slow down and not have the growth we've had over the last couple of years, which by itself is not deflationary, but it's disinflationary.
No, and I think, while we believe that's going to happen and we think that trend is likely to continue, what we've seen over the last 18 or so months prior to a change in presidency is this volatility in the market. Hey, the news seems to be following a certain trend. Okay, things are reacting how we think they're going to react. And then all of a sudden, positive report, economy's strong, everything's great, rates go back up, inflation's going up, no more rate cuts, all of these things. And with that, people get stuck in this cycle of waiting for the top, waiting for the bottom, trying to pick, the perfect scenario in order to move forward. And I've used my example many times, and it probably pisses people off, but I look at interest rates every single day, along with you, Josh. I don't do loans, but I follow the market because it helps my clients. And I've been able to take advantage of dips in the market because I'm on it every single day. And when I see that negative news come out and I see the yields drop, my call is, hey, let's do this if it made sense for me, right? And in those cases, it did. But there's a lot of people that missed out thinking, hey, it's gonna continue, or I want to see it go even further. I mean, you've told me stories about clients. One of them was going to save like $800. It was some crazy number. I don't remember the exact number, but it was a big amount per month. They ended up still moving forward, I believe, but they ended up saving $400 a month instead of, it was like half the savings. Still a good deal, but not the deal it could have been had they not tried to pick the top or the bottom. So I know there's some other factors coming in there, Josh, consumer confidence and some other things that are impacting that. So let's, I guess, talk about those, and then we can talk about what it actually means for buyers and sellers.
So yeah, we talk about the weakening consumer. The Conference Board came out with their consumer confidence index. I believe it was yesterday. By the time you guys are listening, this is about a week old, but it went to 98.3 for the month. That's down 7% and below the forecast of 102. So that's the largest drop we've had since August of 2021, which is still in the middle of the COVID fears. The expectations index, which says what are consumers expecting going forward, it dropped 9.3 points to a 72.9 reading. That's the first time in over a year that measure has fallen below the level that's consistent with a recession. We're past the point of we're not going to sit here and call for a recession because there's been 14 different indicators that say a recession is coming that ended up not being true over the last few years, but definitely a sign that the consumer is concerned that the economy going forward is not going to be as solid as it has been the last couple of years. That will impact spending, that will impact businesses, that will impact the economy. That's disinflationary as money slows its way through the economy and will lead to lower interest rates. So the question really to me, Jeb, and let's go back and let's talk about your situation. You said, hey, because I make YouTube videos, I advise my clients on the real estate side, I watch interest rates every day. I don't think it's your ability to hit those two dips was the fact that you looked at it and go, oh, hey, look, I'm aware that there is a dip. I think you're more aware of how volatile this has been over the last couple of years. And when those dips came, you're like, I'm locking it. This makes sense. Rates could have gone lower. Maybe you would have been disappointed. You ended up right on both of those calls, but you never could have been wrong because you had no cost refinances where you were locking in a significant monthly savings.
So talk about that, Josh, because anytime I talk about that and I say, hey, I got a no cost refinance, I didn't pay any money out of pocket, I didn't build the cost into my loan. I did the same term loan that I had. People are like, how? How do you do that? Like, that doesn't make any sense. Every time I've refinanced, I've had to pay money. So explain to somebody how they can actually do a no cost refinance and not having to pay money or finance it into the loan.
Well, someone's initial response or reaction is, well, there's no free lunch. There's no free rides. You can't get something for nothing. And there is an absolute element of truth. You didn't get it for nothing. You said to the lender, I'm okay with not getting the absolute rock bottom interest rate. I'm not okay with paying anything for my loan. So your loan is fairly large. So you probably gave up 1/8% in interest and you got all of your closing costs covered. Pretty easy decision in that situation when you're saving $300, $400, $500, $600 a month and there's no cost. So in your situation, there's now no sunk cost. So if in 6 months rates drop again, you can do it again, no problem. And again, some of the pushback we get in that, well, you're starting back over at 30, you're starting back over at 30. Only if you're dealing with a loan officer that wants to sell you the maximum payment savings versus asking you, is maximum payment savings more important or staying on track with your current mortgage? Most people, when asked that way, it's probably 60-40. I would say they will say, give me the custom loan term. Give me a 29-year term. Give me a 27-year term. I want to stay on track. I don't want to start back over at 30 years. But in essence, you're not getting something for nothing. There is a cost to the loan. Depending on where you are in the country, closing costs can be higher or lower. So they're going to vary, but you need to know where you're at. If you have a small loan, if you have a $200,000 or $300,000 loan, you're going to give up more than the 1/8% that Jeb did from the best rate to the no cost rate. Because in essence, there is a value, a percentage value of that loan to the lender for a slightly higher interest rate. And that value is used to cover your closing costs for you. So a loan officer should be showing you these options. But what we've seen, Jeb, when we review and do second opinions and get these loan estimates over, 9 times out of 10, I'm not even looking at a 0-point loan estimate. It's someone paying 1.5, 2.5 points to get this wonderful rate. But you look down and they're trading $15,000 of their equity on a $315,000 mortgage. And you're like, this is insanity. The recoup period on this is so far out. Yes, you got a lower monthly payment, but at what cost? It's going to be 8 years before you get your loan balance back to where it was. So that is what the difference between a salesperson and a mortgage advisor. And if someone calls you from the phone, calls you on the phone and wants to sell you a loan, or if you fill out a form online and 12 people call you, or you respond to a mailer in your mailbox, you are talking to a salesperson in a call center. You are not talking to a mortgage advisor. They're not going to pencil out all of these options and help you decide. There's not a wrong answer. Jeb, I've had borrowers say, no, I want to pay a point, get the lowest rate. I'll pay all the closing costs, and I want to give up my 2 years of payments and go back to a 30-year. As long as we've had that discussion and you know what it means and why you're making that decision, that's okay. That's the role of an advisor. to advise you and make sure you are aware. And if you want my opinion, by all means, ask my opinion. Ask me what I would do. But my job is not to make that decision for you. It's to pencil it all out. And that no cost loan option, the 0-point loan option, is really important when we're in a volatile market. And we believe, if you believe as I do, that at some point in the next 3 to 5 years, rates are going to be significantly lower than where they are right now. If we can save $200 or $300 a month with a 0-point or a no-cost loan, I still say do it. We're probably going to do it again, but that's where we want to manage the loan term and all those details that you talked about.
Good stuff. So there's a couple of things we kind of got a little bit off track here, but let's go back to interest rates moving lower. Some things we didn't talk about, Josh. Trump's tariff plans every day seems to change on who's going to be impacted, how they're going to be impacted, what the percentage is going to be, what the market thinks of that, how it's going to affect inflation. So there's a lot kind of stirring in a pot there, and nobody truly knows. But what we've seen is Doge, whether you believe it's good or bad, the reality is there is some cutting to expenses, and the belief is that maybe that helps offset some of the things that are coming down the road. So is that a factor in rates moving lower, or is this just us making up things?
It's not us making up things. We talked at the top of the show that there's a lot of hypotheses out here of what's going on. And several people have mentioned, hey, it's uncertainty around the tariffs. But when you unpack that, you say definitely uncertainty, right? Because off again, on again, off again. How much? On who? On what products? For how long? Are we just using this as leverage to get concessions on other issues? All of those things are true, and no one, and I don't even think Donald Trump in his own head has an answer. He's playing it day by day and using this as leverage. But if the tariffs come into play, there's two equally true but very opposite things about that. In the short run, they are inflationary, because those costs, some of them will be borne by the exporter, some will be borne by the importer, some will be borne by the consumer. So that's an expense on all of them. It's inflationary, right? If it happens one time and stays there, that is just a new level of prices. So it's not long-term inflation, but it does set the new level of prices higher, which no one wants. But over the long haul, those new higher levels of prices will put the brakes on the economy and be overall disinflationary. So in the short run, inflationary, long haul, disinflationary. So if it sounds like we're talking out of both sides of our mouth, we're not. We're just talking aloud to you the same things that market watchers are saying right now, saying these are all true. We don't know what's going to happen and we don't know what it means. So despite the fact that all of the real data that we're seeing may say this trend should continue, we have that uncertainty and that volatility, and it wouldn't shock me to see spikes back up in rates. You know, the long-term trend should be towards lower rates, but we can have shocks at any given time. And that's why, going back, you know, Jeb, a couple people we have on the Rate Watch I just talked to yesterday, and they missed that opportunity in September, August, September, because they felt like rates were going lower. One of them has a rate so high that I'm like, why were you holding out and waiting? The other one, I can see it. The rates just, if he had caught them at the absolute bottom, got to the point where it should make sense. So the beauty of talking about it or looking at it or thinking about it now, if you're a homeowner who bought in the last couple of years and has a higher interest rate, the beauty of looking at it right now is you can less emotionally say, there's the number at which I'm comfortable doing this. So from that perspective, that's what I think you should keep an eye on and be running through those numbers now. So you set this strike point. So when we hit it, if we hit it, you're just ready to go. There's no emotion. There's no more thinking it through. Probably the bigger question, Jeb, or the tougher one right now is, what do you do? How are you advising buyers that are out looking at homes right now and they're seeing rates go lower and go, oh, maybe I should hold off and see if rates go lower? Or maybe they're under contract and saying, do I lock or do I wait and see if I get a better rate in a couple of weeks?
Yeah, I think it's like someone asking, should I buy a house or should I wait, right? There's never an absolute answer for everyone that's going to fit everyone's situation. It's kind of a personal thing, like we started the show and said. But what I do believe is that, what we talked about in the forecast at the beginning of the year, and that's that interest rates aren't going to move in a straight line in either direction. They never have. It's more obvious now because some of the volatility is well, we're reacting to it for one, but some of these jumps are happening just back and forth. It looks a lot like a stock. I mean, it's, up a 0.25%, down a 0.25%, up an eighth, down an eighth, up a half in a couple of, a week or so, and then down a quarter. So it's one of those things that's like, don't try to pick the top or the bottom. Once you're talking, if you're in contract and you've talked to your mortgage professional and the rate makes sense, lock it in. Don't try to pick the top or the bottom, and just understand that at some point in the future, rates are likely to be lower and you'll be able to take advantage of them, assuming you qualify, you have your equity, all that good stuff. If you're on the sidelines wondering if it's the right time to buy because of rates, it either makes sense or it doesn't on paper. And I know that's easier for me to say now that I'm a homeowner, but I will tell you, when I was buying a house and going through the refinance process and even the last house, I would have liked to gotten a lower rate initially. The reality is I did what I'm telling people not to do here, and that's I just waited. I'm more of a gambler, right? We talk about what type of person are you? Are you the person that goes to Vegas and immediately goes to the tables and starts gambling? Or are you the person that goes to watch shows and dinners and you go to the hotel room to chill? You want to go to the spa? I'm the person that goes to gamble. I'm there to have fun. I know there's risk in that. And so if you're the more risky person, then maybe you play that out, but that's never good. It typically doesn't work out for most people, especially in volatile markets like the one we're in now. So I think you have to, cash the checks as they come in, if you will. So lock those rates and then be hopeful that the market moves in your favor. And sometimes it can move enough in your favor within that lock period that maybe you can take advantage of a lower rate during that same period without having to do a refi.
Here's a couple of thoughts related to what you just said. I agree wholeheartedly with everything you just said. If you feel like you're like Jeb, you're a gambler, you head to the blackjack table as soon as you walk in the casino and you want to float, have a bailout rate. We talked about a strike rate. If rates are coming down, if it hits this, I'm going to lock and close my refinance. Cool. If you're in contract and you are sitting here saying, I'm going to wait it out and see if it goes lower, know that they go down more slowly than they go back up, and make sure you have a bailout rate. I am just going to lock if it gets to this point. Because a lot of times we had a listener to the show last fall, and when rates were going against them and they were seeing the data and they felt like they were a little bit of a gambler and they just kept waiting. Well, maybe the next report will go our way. Maybe the next report will go our way. On a $600,000 purchase, they ended up with a 3/8 higher rate than they needed to. If we had just said, hey, here's our bailout. If it goes an eighth higher, we're taking our chips off the table and calling it a day, they wouldn't have had that issue. The other thing that I like to say, if you're on the sidelines deciding when to get in, we know that supply is back to 2019 levels. Supply is elevated relative to demand. Every little bit that rates come down increases the demand. So there's more people to compete against for those homes. So it sounds crazy, but if you want selection and negotiating power, you almost want the rate to be higher so that you have multiple homes that you would be happy with to pick from, that you can walk from one if the price goes away. So again, I would say back to exactly what Jeb said is know yourself, know where you're at, what your thoughts are, and try to make the decisions as much ahead of time of I'm going to follow this thought process so that you're not in the emotion of it, because rates are going to continue to be volatile even if they do trend down. It's not going to be a straight line.
Yeah, and if you're currently in the process to buy or refinance and you're looking for a smooth, stress-free process, Josh and the team have helped hundreds of people here on YouTube, and they can help you. You can go to theeducatedhomebuyer.com/start, fill out a little bit of information. The team will reach out to you and get you started with that process. And again, it's never too early to start. But Josh, if you're sitting on the sidelines right now and you're wondering, right, are lower rates ahead? What are your thoughts?
I think that there are. The key thing to me is going to be the data over the next 2, 3, 4 weeks. And tomorrow, by the time you guys are listening to this, we'll see the January PCE data here at the last day of February. Is that going to be enough to push us through the 200-day moving average? If we get to the other side of the 200-day moving average and stay there for 10 days, 14 days, I'm going to feel a lot better about it. Right now, as of today, I'm looking at it. I'm cautiously optimistic and being very careful around that 200-day moving average. So if I'm in the market and I am floating right now, I'm setting a bailout rate. I'm watching it very closely. And if we bounce higher off of the 200-day moving average, I wouldn't give it a lot of rope. If we get to the other side of it and stay there for 2-3 days, then you could probably feel a little bit better about letting it go.
No, and that's coming from a professional that's been doing this almost 30 years. So make sure you have that professional in your pocket. If you need to be on the rate watch, theeducatedhomebuyer.com/rate watch. If you want to get in touch with the team, it's /start. But if you can be of assistance, or we can be of assistance, you can always reach out via email. But until next time, make sure you buy right, borrow smart, and build wealth. Adios.
Amigos.